Exiting the French tax system wrongly can cost you years of tax exposure even after you have moved abroad. In this video, I'll show you how to cut the tax ties with France properly and become a legal tax resident in Dubai without triggering audits or penalties. Most people don't realize that France look at more than just where you live. I'll explain to you the tax residency test that the French tax office use, how to close your tax ties to France safely, and how the Dubai tax residency really works. Before we start, my name is Shiraz Wahid, and I've helped hundreds of entrepreneurs and business owners move to Dubai with their business and families and help reduce their taxes legally. If you want my help in doing the same, you can book a strategy call with me at setuphero.com/call. Now, if you live in France, you're likely considered a French tax resident. This means that you pay tax in France on your worldwide income. The personal tax burden can be over 45%, and if you own a business, corporate tax and social charges add even more to that. Moving to Dubai can change that completely, but it only works if you exit the French system correctly and set up your life in Dubai the right way. So, what makes someone a tax resident in France? Well, the rules are clear that if you spend more than 183 days in France, you are a tax resident. But even if you stay less, you can still be considered a resident if France is where your family lives, where your main home is, or where you earn most of your income. These are called primary and secondary ties. To stop being a French tax resident, you have to break all of these ties. The first step is leaving France physically. That means spending fewer than 183 days in France during the year. The second step is moving your center of life to Dubai. You need to show that your personal, financial, and professional life is now based in Dubai. That includes where you live, where your company is registered, and where your money is made and managed. Once you have decided to leave France, you must inform the French tax authorities. This is done by filing the final tax return in the year that you leave. You check the box that says you're leaving France and declare your new country of residence. But just ticking the box isn't just enough. You need to back it up with proof. That is where the Dubai setup comes in. You will need a valid residency visa in Dubai. You will also need a company and a work setup that shows that you're active in Dubai. You will need to rent or buy a home and actually live there. You should also move your banking, cut the ties with the French services, and cancel local memberships. France also has something called the exit tax. This applies if you own shares worth over 800,000 euros or own at least 50% of a company. If that's you, speak with your tax advisor before leaving. Most people don't pay the exit tax, but it's important to check before you move. Now, let's talk about the setup in Dubai. We usually recommend using a free zone structure. It's simple, affordable, and gives you 100% ownership. When you open a free zone company, you can apply for a residency visa linked to that license. This visa lets you live in Dubai, open local bank accounts, rent a home, and sponsor your family. Once your visa is issued, you'll officially become a resident in Dubai. There's no personal income tax, no capital gains tax, and a corporate tax is only at 9%. But only if your business makes more than 375,000 dirhams per year, that's close to 100,000 euros. If you earn below that, your company pays 0% as corporate tax as well. To be a fully tax resident in Dubai, you should spend most of your time in the UAE. Spending between 3 to 6 months per year in Dubai is a good rule to follow if you want to be seen as a resident, and you should make sure that France accepts that you have cut ties. That means not having the main home in France and not using French bank accounts and not managing your business from there. Also, you don't have to wait until the end of the year to move to Dubai. Many people think that you need to stay in France until December 31st to complete the tax year, but France does not require that. You can leave anytime. Your tax residency ends the day that you leave and breaks your ties. If you move in June, you may only pay French tax on the first half of the year. Moving to Dubai in summer can also be a smart choice. Fewer people apply during summer months, so the processing is faster. Flights and accommodations are cheaper, and some free zones offer limited time deals like lifetime visas or discount on setup cost. Many of our clients take advantage of these offers last year and they're available again now. Once your setup is complete, you'll enjoy the full benefits of Dubai tax residency. You will be in a low tax, business friendly country with world class infrastructure, a great quality of life, and full control over your income and investments. No more complex filings, audits, or heavy social charges. So, if you want my help in setting up your Dubai company, residency, and banking, and exiting the French tax system, you can book a strategy call with me at setuphero.com/call. We'll go through your situation and build a clear action plan that works for you. And if you're serious about using Dubai for your business, you should really check out my next video right here.